Yeah, hey, thanks a lot, Marty, and I appreciate you guys having me back at the conference. Last time I presented to this audience was in February of this year, and a lot of what we had to say, I think, is still relevant and salient to what's going on in the market. It's just our case has been pushed back about 6 months from where we were, and there's a lot of reasons that explain that. But the first thing I wanted to do is just let people know that we do have a detailed monthly newsletter that we publish the first Saturday of every single month. And so if you're interested in our work and you want to see where we're at from month to month and stay current with what we do, check us out. We're on Substack. We're a top 100 finance newsletter now. It's hugeinsights.substack.com. And the name of the newsletter is Huge Insights, the Big Picture. We've been writing it for about 3 years now. And our most recent publication came out on, I believe, the 3rd of September, and it was entitled On the Road to Serfdom. And we'll kind of start with this big picture view, looking at the economic cycle.
Before you go any further, can you introduce yourself and give some biography and history about what you've done?
So for those who don't know me, I've been working on Wall Street for over almost 35 years now. I spent the first 25 years on the sell side, and then I went to a hedge fund for about 4 or 5 years and did global macro work, as well as ran the short book for a while. And then I kind of retired from the street in 2018 and launched my own institutional research service, a global macro service known as Alpha Insights. So that's the whole title of the presentation, Alpha Insights. It's the name of our institutional service. And 3 years ago, we launched this newsletter, Huge Insights, kind of for those who didn't want to get the gory details of the institutional report. But so we have been around for quite a while, and have seen a lot of bull markets and bear markets. And so I guess our perspective comes with experience. So looking at that experience, we've taken a lot of our training specifically as an economist and as a market technician. We did a lot of technical work when we worked on the street, and we've created some models that have pertained to both the economy and the markets. And the first model is our economic cycle model. It's a long-term 110-year series of data. And what we've done is we've detrended the Dow Jones Transportation Average. And that detrending, looking at that very cyclical index through the lens of its own momentum, and this is a quarterly frequency. So what we can see here is a pretty prevalent sine wave, indicating the peaks and troughs of that cyclical momentum going back to the early part of the 20th century, right? Back 110 years. And of course, the cycle was slated to top in late 2022, and it looks like it topped right on schedule. And now what we think for the next roughly 15, 16 years, we're going to be looking at an economy with the wind in our face, okay? We had a nice tailwind, from kind of the mid-2000s up to present. And from this point going forward, down to around 2039 is where we expect the cycle to bottom next. The wind is in our face rather than in our sail. And we're going to talk about a couple of the reasons why next. The first is the national debt. It's kind of the elephant in the room. As a lot of people are well aware, the CBO puts out a projection of U.S. debt to GDP, and they had been projecting a 100% debt to GDP ratio this year. It's actually 120. They've been off by a full 15% from where it should be. It's 15% higher than where they thought it was. And the problem is, and if we look at research put together by the Aspen Institute, it's only going to get worse. It's actually projected to reach 180% by 2053, less than 30 years into the future. But if you think about this from the standpoint of history, Reinhardt and Rogoff did some extensive research looking at over 40 countries over the last 200 years. And what they determined is that whenever debt to GDP approaches 90%, the GDP multiplier effect of each additional dollar of debt actually falls to about 1. And when it exceeds 90%, it turns negative. So right now, every new dollar of debt that we produce actually has a negative effect on GDP. And this is as the US runs about a $1.9 trillion budget deficit with full employment, no less. Debt's evil twin is the deficit. And, of course, we're looking at Aspen Institute again because they've done some really extensive long-term research here. Some of the greatest minds in economic research coming together to determine that, in 2024, we're currently running a budget deficit that's projected at about 7%. But that is expected to expand over the next 30 years to around 10% by 2053. And there's really no turning back. We've reached a point where it's impossible to balance the budget. It's impossible to pay off the national debt. There's just not enough money without inflating radically. And we've already seen that big inflationary punch, that 25% forklift change from 2019 to present, that's crushing the bottom half of the economy, right? Those that are living paycheck to paycheck. The problem is this is going to be affected by demographics, right? As the US population over age 65 rises from around 17% today to 22% over the next 30 years, it is going to put incremental stress on the budget deficit. So there's really no turning back from this. It's only going to get worse. And as Marty and I were talking offline earlier, we've just crossed the line where the U.S. is paying $1 trillion a year in interest alone. And I think that yesterday's 50 basis point cut by the Fed was more to help fund the budget deficit than it was to assist the economy in any way, shape, or form. But we'll talk more about that. We just ended the most severe rate cycle in 40 years yesterday with a 50 basis point cut. We saw the Fed raise their funds rate from 0 to 5.5% over 17 months. They then held it there for another 14 months, which was unprecedented. Now the Fed says that they're trying to get back to neutral. But if we take a look at the 2-year Treasury yield, which is currently down around 360 or so, we can see that the Fed is already still about 130, 140 basis points too tight. And so they are already behind the curve. And if yesterday's, 50 basis point cut in Powell's own words was to show the street that they will not allow themselves to fall behind the curve, he's a little late to the party with that statement. So we're in a new policy easing cycle. It began yesterday at 2:15 New York time. And what should we expect from that? Well, if we look back in history to the 2001 period, where the Fed began aggressively cutting rates with a 50 basis point cut, I might add, it happened concomitant with a 49% decline in the S&P 500 before they got down into that target range, which ended up being around 1%. The next time was from 2007 into the 2009 lows, where the Fed cut rates again by about 650 basis points, and we saw a 56% decline in the S&P 500. As the Fed held rates near 0%, we saw the S&P climb back up and reached a valuation of 31 times based on the Shiller-Cape ratio before the COVID crisis sent the Fed into a crushing rate cutting cycle again. And during that period of time, we know that we saw about a 38% decline in the S&P 500. But the Fed actually began cutting rates well ahead of COVID. This was from basically 2019 during that reverse repo problem that was identified. And it means that basically the Fed is following the market effectively. And where we are today at 550 down to 500 on the Fed funds rate, at a valuation on the Shiller-Cape ratio that at 36.4 times suggests that we're really in nosebleed territory in terms of valuations. And the Fed is really just trying to support the market and really support the Treasury maybe more than anything. Core inflation continues to remain pretty sticky. Everybody focuses on what the Fed is telling them, but they're not necessarily focusing on what the Fed is focused on. The Fed has 9 different models that they follow very, very closely. And those models have their own targets that have been, that are based on 2% core PCE. And if we take the average of these 9 models, we can see that where we are today is about 119 basis points above the Fed's target. And it actually increased in the most recent print. And so, at the end of the day, I think, there's a high probability that the Fed's just walking this kind of tightrope between inflation and growth, right? Where we're already starting to see some evidence of slowing growth showing up in the labor market. And, and we continue to have sticky inflation. So if the Fed gets too aggressive, we could see inflation spike back up. But if they're not aggressive enough, we could see unemployment spike back up. And so it's kind of a damned if you do, damned if you don't situation. They're really in a box. And, we've got 5 models that we've been talking about for some time now. 3 of them had been signaling recession. There were 2 holdouts. One of those holdouts was the SOM rule. This was our unemployment model. This actually signaled, the SOM rule triggered a recession signal last month. And, even Claudia Sahm herself was out saying, oh, don't pay attention to this, look the other way. But, pay attention to reality, okay? The SOM rule has never, ever before ascended above 0.55% without the economy already being in a recession. That's this red line. And we're above it right now. Now, just because Claudia says it's different this time, I don't know that it is, and I don't know that she knows that it is. Every single time we can go back in history to 1960, when we've got above that 0.55, we've been in recession. We're now at 0.57. And I think we have to respect the data and not people's opinions. I think there's a very high probability that the U.S. entered recession, possibly during the month of July, but certainly during the 3rd quarter here. And, we won't know until the NBER announces this, and they never announce it until the recession's over, and they always backdate it to some point in the future that's well before the consensus view agreed that we were headed for trouble. And so I think we need to be cognizant of that. The second thing we need to be cognizant is the yield curve. This is our other model that we've been watching with great concern. We had the longest inversion since 1980-81. Francois Trehan did some interesting work. He said it's not the depth of the inversion that matters so much as the amount of time that the curve is inverted. And based on history, the amount of time that inversion, or the curve sustains an inversion is directly correlated to the severity of the oncoming recession. Well, we've now uninverted. We are now at a steepening. We've been steepening for many, many months, but the curve is now uninverted. And that's when the torpedoes are in the water. That's when recession is either in progress or is very, very close to engaging. And so, the average recession since 1957 has been about 10.3 months. And I think we should expect, the better part of the next year to present recessionary conditions. Now, if we are in fact headed for recession or in recession, then past recessions and earnings drawdowns become very, very germane. And, historically, every recession since 1957 has been accompanied by a severe earnings drawdown. And if we look at the research published by D.A. Davidson, looking at the past 10 recessions, the average EPS decline is something like 30%, 29.5%. If you take out the 2 worst instances, which were the tech wreck and the great financial crisis, it's averaged about negative 18.7%. Well, if we just assume, say, a 15% earnings drawdown, so about half the average, and we take a look at where current consensus estimates are based on IBIS consensus data, forward 12-month S&P op EPS are currently forecasted at 266. If we do get that historical decline, we're going to be looking at something closer to about 187 in earnings. And so if that's the case, the market's grossly overvalued. And I think, if we're heading toward recession over the next 12 months, I think we are, then valuations are going to begin to matter very, very soon. So where are we in terms of valuations? Well, we're in some instances at the greatest extreme in history. Price to book value now set an all-time record high during the month of August at 5.11 times. So that should tell you that we're at a new extreme. Price to sales is about 3 times. The all-time record high was 3.1 times, and that was in January of 2022. If we look at dividend yield, we're at about 1.27%. That's just off the 2000 lows. And actually, if we take a look at the Shiller PE ratio, this is that cyclically adjusted PE ratio, we're at 36.4. That's just below the 20-year cycle high of 38.6 and the internet bubble high of 44 times. So we're right up there in the top decile of valuations on every single measure. Another measure people like to point to is U.S. market cap to GDP. This is Warren Buffett's favorite indicator. We're at 197%. The all-time record high was in 2022 at about 210%. But the internet bubble high was 143%. So we're well above that last cycle high and just below the all-time record high. We did some work back when we were working at the Leuthold Group, and what we learned is that when we're at valuations that are in the top decile across all of these different indicators, the forward returns average over the next 10 years about 3.2%. That's less than a 10-year treasury. And based on these valuations, just to say the least, it doesn't look like the market's pricing in an imminent recession. So the question is, what's priced in and what's not priced in? We do not believe recession is priced in. In fact, it's very interesting when you look at returns this year. The bull market of 2024 is largely a focus on the S&P 500, but the median stock is actually underperforming T-bills, and the mean stock is only barely outperforming T-bills. And in fact, if you look at the benchmark, it's dominated by just a handful of mega cap stocks. The top 10 stocks count for over 40% of the market cap of the S&P 500, and a lot of those are the Magnificent Seven, the big growth stocks of the NASDAQ. And so if we just kind of isolate where the performance is coming from, it's coming from, the Magnificent Seven and the mega cap, cohort themselves, which has pushed the benchmark up. The interesting thing is none of those indexes are outperforming gold. So why is it that gold is up 26% year to date through last Friday's close, while the median stock is barely positive and underperforming T-bills? Well, there's a couple of answers to that question. And one of them is that the market is pricing in an event, okay? Maybe it's a geopolitical event. Maybe it's another surge in inflation. But we don't think it's looking backwards. We don't think the gold market is adapted to an inflationary condition that was priced in 2 years ago. We think it's pricing in the future, okay, like most markets do. And we can also look at the sector rotation that's underway right now. On the left-hand side, we have a weekly relative strength rotation, and on the right-hand side, it's the monthly or more structural. And the thing that we see on the weekly side is that, REITs, utilities, staples, and healthcare are leading the market from a relative strength perspective, within a sector rotation framework. What's doing poorly? Communications, technology, and also energy. Energy's pricing in a recession. And now tech and some of these other cyclical businesses are as well. If we look on the monthly structural side, we can see that communications and technology have dramatically lost their upside momentum, and they're rotating into a weakening sort of dynamic. Meanwhile, REITs, utilities, staples, healthcare are all rotating toward an improving sort of perspective. And of course, financials as well, benefiting from a re-steepening of the yield curve. So this shift into defensive sectors, their domination is not something that one would expect at the beginning of a new bull market. It's what you would see at the top of a structural bull market that is turning into a bearish posture. So investor sentiment's another issue that we've been focusing on. If you look back to 2022, we see these multiple tops over a course of a number of months preceding the 2022 high and following it, where professional investors, as measured by the National Association of Active Investment Managers, have been very, very leveraged, very, very overinvested. And we saw the same thing here for the first 6 to 8 months of this year. And then suddenly we're seeing a reversal down. Similarly, the bull-bear spread for the American Association of Individual Investors back around that 21-22 period got very, very optimistic, right? And that was followed by a severe decline toward a deeply pessimistic condition. Same thing today. We got, levels of optimism not expressed back since that period of 2021-22, which showed up in, say, December of last year and the early months of this year, and it's now reversing back down. But we're nowhere near pessimism. And one thing my old boss Steve Leuthold used to say is that changes in attitudes tend to coincide with changes in latitudes. And what he meant by that is when the stock market starts to go down, people start to get bearish, right? Right now, with stock market at an all-time record high today, these structural measures of investor sentiment are already starting to wane, and that should be a concern. This is a 100-year structural perspective of the S&P 500. We use a model known as the Elliott wave principle to kind of, as a roadmap to where we are in the, long-term structural framework of the market. And what we see right now is the end of a 92-year bull market from 1932 to present, as measured by the Elliott wave principle, where at cycle degree of trend, we can count 1, 2, 3, 4, 5 waves. Wave 3 oftentimes subdivides very characteristically at primary degree, and we can count again 1, 2, 3, 4, 5 waves at primary degree. Clearly, this wave 4 low, which was an ABC corrective waveform, is the launching pad for the last 15-year bull market that was really initiated by the Fed, bailing out the banking system and cutting rates to zero and engaging in QE all the way up. And if we really dig deeper and look at that 15-year cyclical perspective, that last leg up, we're just talking about from cycle wave 4 to cycle wave 5. And we blow that up and look at it on a monthly basis. So this is a 15-year monthly chart. What we've done is we've taken the S&P equal weight index. And the reason we're using the equal weight index is because it avoids what's happened with this heavy concentration in this last leg up in the AI Magnificent Seven type stocks, and kind of keeps things on an even keel. So what we're seeing here is more consistent with what we saw all the way up. And again, we can count at multiple degrees of trend, a 1, 2, 3, 4, 5, 4, 5 sort of pattern. And we see the subdivisions here at intermediate degree of trend, 1, 2, 3, 4, 5. And this final leg up off of the October 27th low last year, which we count as primary wave 4 of cycle wave 5 of super cycle wave 3, that traced out what we call an ending diagonal triangle. That pattern only shows up in the final 5th wave. And so we think that this is a termination pattern. And oftentimes you get what's known as a throwover, a 1 or 2 or 3% push above the upper boundary. And then we're seeing that today, as a matter of fact. This chart was from a couple of days ago, but if it was an updated chart, we'd see a slight throwover here. And we think once the market comes back into this triangle, that will indicate the end of the upside. The other thing that gives us a pause for concern is this big negative divergence. We're using an 89-month simple moving average to kind of define the trend. It's marked all the lows going back to primary wave 2 of super cycle wave 5. And here we see that momentum peaked at primary wave 3 and is about a third lower at this primary wave 5 high. And so we think that's an indication that the trend is coming to an end. Now, if we look at it from a really tactical perspective, a 2-year, simple weekly chart, we can count from that October 27th low last year, a 1, 2, 3, 4, and a final 5th wave up. And I didn't put this chart in, but if you looked at the trading perspective, just kind of a 2-month trading perspective, and looked at this final wave up, there's a 1, 2, 3, 4, 5 move. And even this final 5th wave has a 1, 2, 3, 4, 5 through today. And so we've got, an impulsive move to the upside that looks like it's terminating at every degree of trend down to sub-minute basis. And we think that this weekend is going to be critical. A lot of people are probably familiar with the importance of the autumnal equinox, which actually takes place on Sunday. Because it's a Sunday, we have to look at Friday and Mondays as potential turn dates for that cycle. We think a big structural cycle, similar to what we saw in 1929, which was the last time that this occurred, is coming into play this weekend. And I think it's going to have something to do with what's going on in Japan. And we'll talk about that in just a second. Because people have been asking me, well, what's the catalyst for all this, Jeff? You've got this really laid out, okay, but it doesn't look like the economy is going into recession. What's going to be the catalyst? Well, we've got a major event coming up. It's the 2024 presidential election. And you guys might recall that I talked about this back in February. And I said, I didn't think that Biden was going to be the candidate. In fact, I said, I thought that they were going to replace him with Michelle Obama. And everybody laughed and poo-pooed it. And I think even Marty called me out on the carpet and said, all right, guys, who believes that Joe Biden's going to be the candidate? And I think the results were unanimous that he was going to be the candidate. And while I didn't get Michelle Obama correct, it is a Black woman, and there was a change. So I think I get 2 out of 3 ain't bad. But with Harris now running, looking at what 538 does, and they do 1,000 simulations, it now looks like Harris has a 61% probability of victory here. Now, what does that mean for the markets and the economy? Well, I don't know, but it's not going to be a status quo. She's going to make a lot of changes. She's got her own agenda. And, I think if Trump were to win, that could be even worse for the markets. I think that's a big inflation trade. But I think actually what Harris is talking about is actually a deflation trade. She's talking about increasing supply dramatically in the housing market. And of course, Marty and I were talking offline about how unaffordable housing is. Well, she's going to make it affordable. And I think that's going to be deflationary for the largest asset in most people's portfolio. Now, the good news is it looks like the Republicans have a modest lead in both the House and the Senate. And I think if we get a divided, if we get a Democrat in the White House and we have Republicans dominating Congress, I think that's a good thing for the markets because it'll keep, changes to a minimum and closer to the status quo. But, anything can happen. And I wouldn't rule out any, conceivable amount of chaos at this particular election. The next thing that I think is a big deal right now is the unwinding of the yen carry trade. And, the real question, I think, is how big is the yen carry trade? Well, the answer is nobody really knows for certain, but there have been some credible estimates ranging from about $500 billion to $20 trillion. Whether you fall on the high end or the low end in terms of your personal view, the one thing that everybody agrees about is only about 200 billion has been unwound. And most of that occurred from about July 31st to August 5th. And that coincided with a 12% decline in the Nikkei, which was the worst trading day since the crash of 87, and a big spike in the VIX to 65% in the pre-market. Now, at the end of the day, I think that leaves a lot of room for continued deleveraging. But if you take a look just at net international investments for Japan, you can make a very, very good case to support the high end. Net international investments are now close to 500 trillion. And that equates to about 20 trillion in US dollars. So if in fact the yen carry trade is that big and we unwind, something like a third to 2/3 of it, it could definitely create a level of volatility that nobody is prepared for at this point. The final thing I think we have to be aware of is the new Axis powers. This informal alliance between China, Russia, and now Iran, and we can even throw in North Korea to a lesser extent. But at the end of the day, it's clear that none of these guys play by the rules, right? And they're marching to a different drummer. And one of the things that's been occurring is, they've recognized that the U.S. has weaponized the dollar and used sanctions to punish bad behavior. And so none of them want to be punished. And so what they're doing and what they have been doing for some time is kind of creating their own contra, World Bank system that's backed by the currency of gold, because none of these guys have exchangeable currencies and none of them really trust one another. But they do trust gold. And I think, their ability to settle trades in their own network in gold is going to be very, very important to, holding the U.S. at bay and forcing the U.S. to take military action instead of economic action against these guys. And I think, the one thing that's kind of holding Xi Jinping back from Taiwan is the failure of Putin in Ukraine. I think if Putin marched into Ukraine and took over the country in 2 months, China would have already launched, an invasion of Taiwan. I think the simple fact that Ukraine is hurting Russia and killing Putin's credibility is what's kept Xi at bay. But he's got to do something, and he's got to do something fast because, from an economic perspective, he is not fulfilling the promises he made 5 years ago. So with that, what do you do? Well, I think preservation of capital remains key in this environment. If we take a look at the valuation of the major asset classes today versus the 40-year mean, we're looking at U.S. property prices trading at basically 3 standard deviations above their 40-year mean. We're looking at the S&P 500, a good proxy for stocks, trading at greater than 1 standard deviation above its 40-year mean. We're looking at commodities trading at about their average of the last 40 years. The one thing that looks cheap is treasuries, and that's not to say that they can't get cheaper, but currently they're trading at a discount to their 40-year mean. And from that perspective, one could draw the conclusion that T-bills still might provide prudent investors or risk-averse investors with the best combination of value, safety, liquidity, and yield over the next year. So I've got a strategy that I think anyone can employ that could really save your portfolio over the next 12 to 18 months. And that's this simple barbell strategy. And we've employed it at our shop. My shop is a single family office that runs my family's capital. And we've got a huge overweight in gold. And we've been overweight gold since November of last year. So we've actually taken a nice, experienced a nice outperformance relative to equities during that period. But the other side of that barbell is cash. We've had a huge position in cash, earning 5% risk-free. And just, combining the two, we've got a better than 30% return year to date in that combination, which is, an average of 15% for the whole portfolio. In the middle, we've got, more traditional asset allocation across a whole variety of different equity, long, short, hedge funds, as well as, taking a look at certain, undervalued markets in the world and, positioning ourselves across credit markets, we think in a prudent way, as well as real estate in a prudent way. And one of the things that we've been proud of is the simple fact that we got the REIT trade right. We've got an overweight REITs in our equity allocation. So something else that we think that this does is it really provides the best strategic hedge for any portfolio against inflation and currency devaluation with that hard asset gold position, and a liquidity hedge against deflation and recession with that heavy cash allocation. And it also provides an uncorrelated alternative to the traditional 60-40 stock bond portfolio. So with that, I'll open it up for questions.
Yeah, Jeff, it's kind of overwhelming, but I think I wanted to go back to a couple of at the beginning of your slideshow and talk about a couple of slides you have there. We had a guy on who said that the underpinning Fed strategy is to support the market at any cost, because most of the budget that's discretionary for spending is with the super wealthy these days. And so they stop spending, the whole thing kind of, comes down because the 90% that you quoted don't have any money to really spend on, marginal assets or marginal pleasures, right? So,
Yeah.
yeah, any thoughts on that?
So one thing that I would point out is that the Fed has to issue about 1.9 trillion in new Treasury issuance this year in aggregate, and it's going to be about the same next year or more. And so, there's got to be, they've got to raise capital basically to fund this deficit, and that is going to tighten up the credit markets a little bit. It's going to take a lot of capital that would otherwise go into risk assets, right? And so one of the things that the Fed really has to focus on is helping the Treasury control that line item in the budget called interest payments. And by cutting the Fed funds rate, since most of the issuance is coming at the short end of the curve, I think that will continue, and they'll be assisting, kind of at least holding that line item, around $1 trillion so it doesn't spiral out of control. But of course, the wealth effect is the other big thing, keeping spending going. The problem is that, with the ultra wealthy, they really don't spend that much. They have lots of assets, and, they're spending, you're talking about really, less than a full percentage of the population, and they account for maybe 5% of total, consumer spending as a whole. So it's not that big of an impact there, but it's the wealth component. And if we did see the stock market experience a 20+% correction, they would go into overdrive trying to support it, because that would cause the wealthy to pull way back, and that would have an incremental impact.
Right. I think on your political map, there might be some disagreement. I think Nate Silver has kept on, he's flip-flopped a couple of times on his predictions. So who knows what it'll be next week?
Well, yeah, and I agree. He's doing these simulations, right? And his
Yep.
models are probably the best out there. They're not always right, but he's got a pretty good track record. So right now, and there's a lot of time between now and the election, right? But right now, Harris has the advantage. So we'll see. I think things will be worse if Trump is elected, because I think his policies are going to be largely inflationary, and I think that's going to be worse than deflation.
Yeah, I'm trying to understand how $1.87 gasoline is inflationary, but maybe,
Wow.
I haven't seen $1.87 gasoline, but in the Twin Cities, Minnesota, where I live, it's about $3.50. I'm actually in California right now. It's about $5.50 a gallon here. A lot of that's taxes, of course, but that's just one element. I think a lot of this is just people have been priced out of the market for everything. The average guy can't afford to spend $47,000 on a new car, which is the average new car price. He can't afford to spend $475,000 on the median family home. It's just beyond his reach. Even though interest rates have come down, mortgage rates are still above 6.5%. I mean, that's nearly 3x what they were at their lows. And so, this is putting a lot of pressure on the budget. Egg prices are out of control, right? And, these are all things that are going to change. These are high frequency numbers, right? But, there's the bottom half of the U.S. consumer population is suffering. There's no question about that.
So, in regards to your geopolitical perspective with, Russia, Iran, and China, I guess that China historically has held a lot of U.S. treasuries, right?
They've been selling them dramatically. They're well down. I think somewhere around 700 billion now, down from 1.4 trillion.
Right. I'm just saying historically they've had a lot. I think a lot of people think that China's taking the very long game on Taiwan, which is, if you notice that there are alliances and people that join the Silk Road or whatever their initiative's called, the BRICS.
Yeah.
Most people who joined it and signed agreements to get funding from China tend to turn their vote in the UN against Taiwan, or drop recognition of Taiwan. So I think there's a long game that's being played that may not take any arms at all to do.
Well, that's absolutely, it's true. But the other thing to understand is that Xi promised reunification by 2027. That's only 2 years away now. And so, will he do it through diplomatic measures? I mean, Taiwan's largest trading partner is China. So that's what's driving. Yeah, actually, Taiwan's GDP is higher than China's right now. It's 4.8%. China's like 4.3%, I believe, and declining. And China's actually been disguising the decline in their growth rate by manipulating the statistics. And so it's probably even worse than that.
And you're saying the growth rate of
Um,
Taiwan is higher than the growth rate of China.
It is, and it's because of their trade with China. So they would be shooting themselves in the foot by, engaging China. It's in their best interest to do this through diplomacy. But China is making it clear that this is going to happen. And I think the U.S.'s biggest interest is, making sure that our intellectual property in the semiconductor industry is not, subject to sort of infringement by China. And so they want to protect that at all costs and move all of that, high-end, sub 20, 20 nanometer production off Taiwanese shores. And so, a lot of the new foundries that are being built in the U.S. will handle that production specifically. And you'll be looking at, the stuff that's based in Taiwan right now is being kind of, legacy technologies being manufactured there. But be that as it may, all the foundries, TMC's foundries, are wired for detonation right now. So if there is an invasion or incursion of any sort, they would blow up the foundries before they'd allow them to fall into Chinese hands. But, while the Chinese could storm the beaches easily enough, once you get on the beach, it's pretty tough country out there. I don't know that they'd have much success in the mountains of Taiwan with their tanks.
Yeah, people imagine that China this is a new thing. They don't respect intellectual property, but that's been ongoing. There's that story about the Spaniards, and when they discovered the Philippines, they thought it was, amazing, and they used it as a launching point to send European exports to China for 10 years. So every year they would send, a ship to China full of, European items. And then 10 years later, China came back with a whole fleet of copies of all those items that they had sent over. So, anybody who's lived in New York and walked on Chinatown knows that there's the ability to knock off intellectual property is a mainstay of the culture.
Yeah, I think the real issue is AI technology, and how long can we protect it? That's the key. Whoever dominates the AI market first is going to win long term. And so the U.S. knows that, and they're going to go out of their way to protect our intellectual property interests on that front.
It's interesting times. Hey, Jeff, some people in the audience have requested the presentation. Can you send me the deck and I'll post it?
Absolutely.
Fantastic. Great job. Thank you so much.
Hey, you're welcome.